Welcome, investors, to this explainer on navigating the highly lucrative but often misunderstood dual-state real estate market of Kansas City. If you're an active investor or you're just considering jumping into this fantastic metro area, well, you're in exactly the right place. Today, we're guided by data and practical insights from Alpine Property Management, Kansas City. They've been serving investors across this exact market since 2013. So let's open up the Kansas City Landlord State Line Playbook for 2026. Inside this playbook, we'll explore how the Missouri and Kansas state line fundamentally changes your rental property operations. We're covering the Kansas City divide, ground rules and deposits, eviction realities, cash flow versus appreciation, the property tax factor, and finally, winning the metro market. Just a quick heads up before we dive in. This data-driven guide is purely for educational purposes. We're looking at market strategies and operational realities, but this definitely does not substitute for professional legal or tax advice. Always consult your own legal and financial pros when structuring your investments. All right, let's begin with Section 1, the Kansas City divide. So the single most common point of confusion for out-of-state investors is realizing that this one metropolitan area actually contains two completely different operating environments. Unlike most cities that sit neatly inside a single state, Kansas City is physically split right down the middle. Imagine this. A rental in Missouri and a property in Kansas might only be a quick 20-minute drive apart, but they are governed by entirely different sets of landlord laws. Investors often buy on one side, assume the rules they know apply across the border, and, well, they get a very unpleasant surprise down the road. Moving right along to Section 2, ground rules and deposits. We'll cross into the specific legal differences. The financial mechanics of tenant turnover literally change the second you cross the border. The deposit rules are a perfect example. Missouri allows you to hold a significantly larger deposit of up to 2 months of rent, and that actually includes any pet deposits. On the flip side, Kansas strictly caps unfurnished unit deposits at just 1 single month of rent, allowing only a half-month extra for pets. Furnished units give you a little more leeway at 1.5 months, but it's much tighter overall. Plus, while both states give you 30 days to return the deposit with itemized deductions, the clock starts differently. In Missouri, the countdown begins right at move-out, but in Kansas, it begins after lease termination and the return of possession. Because of this, your risk management and screening processes absolutely must adapt depending on which side of the state line your property sits. In Missouri, having that larger deposit cushion is highly advantageous, especially for higher turnover, cash flow-focused neighborhoods. But over in Kansas, that smaller deposit means your margin for error is razor thin. Your upfront tenant screening on the Kansas side has to be significantly tighter, simply because you don't have the same financial buffer against property damage. In Section 3, eviction realities, we need to address the operational timelines in both states. Investors constantly ask the million-dollar question: which state is actually more landlord-friendly when it comes to removing a non-paying tenant? Is eviction faster in Kansas or Missouri? Well, the answer might surprise you. The honest truth is that your eviction timeline depends heavily on the specific county court's rhythm and whether your property manager filed perfectly clean paperwork. Both states require proper written notice before you can even file. In Missouri, Jackson County follows a very defined path from notice to hearing. Over in Kansas, Johnson and Wyandotte counties run completely distinct dockets with their own unique pacing. But hear this clearly. A sloppy notice or a single paperwork error gets dismissed and resets the clock everywhere. No exceptions. This is exactly why having a seasoned property manager like Alpine who files in these courts regularly is just invaluable. Now, while evictions can be complex, there is some fantastic news for your revenue growth. Fortunately for investors, neither Missouri nor Kansas has rent control. In fact, Missouri's state law preempts local rent control entirely. This means landlords on both sides of the metro can freely set their rents at market rates without any regulatory ceilings holding back their cash flow. Let's transition away from the legal rulebook for Section 4, cash flow versus appreciation. This strategic divide is what really defines the market. Missouri neighborhoods like Independence and Raytown offer a much lower entry basis, typically between $120,000 and $140,000. This provides incredibly strong gross yields, usually in the 8 to 10% range. Alternatively, Kansas areas like Overland Park and Prairie Village demand a much higher entry price, frequently approaching $400,000. However, they deliver top-tier schools, phenomenal long-term appreciation, and rock-bottom vacancy rates of just 3 to 4%. So, your specific financial goals will directly dictate which side of the state line you should target for your next acquisition. The Missouri side is fundamentally built for strong cash flow, executing Section 8 strategies and capturing higher immediate yield. On the other hand, the Kansas side is structured for long-term appreciation, attracting tenants looking for premium school districts, and enjoying unmatched tenant stability. Now for Section 5, the property tax factor. This is a major operational cost that quietly impacts your returns. Property taxes differ significantly by state. In the Kansas City metro area, Missouri residential property tax runs right around 1.1% of the assessed value. Meanwhile, Kansas comes in at a noticeably higher rate, sitting closer to 1.4%. That percentage difference might sound small at first, but applied to the property values we just discussed, it is massive. A $300,000 Kansas property versus a $140,000 Missouri property creates a major dollar difference in your annual tax burden. You absolutely must include this tax difference in your initial cash flow underwriting. Just recognize that the higher Kansas tax rate is simply the inherent trade-off you pay for stronger asset appreciation and incredibly low vacancy. Finally, in Section 6, let's talk about winning the metro market. The most successful investors in Kansas City don't fear the state line. They leverage it. Many successful investors deliberately hold properties in both states to perfectly balance high cash flow doors in Missouri with high appreciation doors in Kansas. The real key to this winning strategy is treating the two states as entirely distinct operating environments. You cannot use a one-size-fits-all approach here. You really need to partner with a management team that operates daily on both sides of the line, a team that understands the precise legal and operational nuances of your property's exact address. The state line is only an obstacle if you're unprepared. Once you understand the playbook, it becomes your greatest strategic advantage to balance immediate cash flow with generational wealth building. The only question left is how will you leverage this divide to scale your own portfolio? For help managing your Kansas City rental property, call Alpine at 816-343-4520 or visit alpinekansascity.com.